The year is 2025. The world watches whether Donald Trump, now in his second term, considers a bold move monetizing America's gold reserves. Could this be the moment of Trump's golden age for America, or will it be a gamble too far, and another example of a Trump tantrum? Trump's stance on economic, tariffs, and immigration policies has always been unconventional and controversial. He's known for his preference for tariffs and his skepticism of the Federal Reserve. Now, he's set his sights on gold. This isn't just about economics, it's about Trump's MAGA vision, make America great again. He wants to reduce the national debt, boost infrastructure, and compete with mighty China in all aspects to restore American dominance on the world stage. Can gold help him achieve these goals? The jury is still out. The price of gold is soaring. Since Trump's re-election, it's been on a roller coaster ride, reaching new highs of almost $2,950 from $2,550 before the U.S. election in November 25. That is a rally of almost 15% in 3 months despite the Gaza war ceasefire. It's currently hovering around $2,900 an ounce. The markets are clearly confused. Trump's policies are a major factor. His trade wars and unpredictable foreign policy have created a specter of global uncertainty on both sides of the Pacific and Atlantic. Investors are flocking to gold as a safe haven physical asset. They see it as a hedge against inflation and economic turmoil. But there's more to it than just Trump. Global events are also playing a role. The fragile ceasefire and Gaza war, simmering tensions in Ukraine, and a weakening local currencies against the US dollar across the globe are all contributing to the gold rush. The question on everyone's mind is this: is gold still a safe bet after an almost 135% rally in the last 4 years, or a bubble waiting to burst? Some analysts believe gold is overvalued. They point to fundamental correlation or valuation relative to inflation and money supply, technical indicators, and historical trends. They warn of a potential correction from around $2,950 to $3,050 levels. Theoretical price or fair valuation of gold, inflation-adjusted gold. Price, $2,242. M2 money supply, adjusted gold price, $2,583. Gold to S&P 500 ratio value, $2,987. Overall, the average fair value of gold may be now around $2,600 against present levels of $2,900. Looking ahead, gold may correct due to various reasons. Gaza and Ukraine war, permanent ceasefire, and lower geopolitical tensions under Trump 2.0. Less hawkish approach by Trump 2.0 on Tari 9 FFs and immigration, resulting in relatively muted inflation. Less dovish Fed monetary policy and higher USD-US bond yields. Gold may have surged too much above its fair value for various reasons in the last year, especially after the Gaza war started in October 23. There was a central bank buying spree led by EM central banks like India's RBI, Poland National Bank, and Turkey's central bank. But in 2025 we may not see so much gold buying by EM central banks due to USD scarcity. Another factor behind gold's record surge may be the market perception that record issuance of gold ETFs may have inadequate backing of real physical gold. At COMEX and LMBOE, there is heavy demand for physical gold in the US, and BOE, LME scrambling to supply the same. They believe gold has further room to run to around $3,050 levels. Now, if Trump is considering monetizing/selling/pledging part of gold held by the US Treasury to pay off US debts partially and reduce bond yields, it may lead to huge panic selling of gold. Trump 1.0 repeatedly pointed out lower borrowing costs and warned Fed Chair Powell either to cut rates or resign. Now Trump 2.0 is not targeting Powell Fed directly, but still urging for lower borrowing costs by keeping bond yields lower. Trump may be now planning to reduce U.S. debts by selling part of gold to support deficit spending and not issuing fresh U.S. treasuries for the same. The gold market is notoriously volatile. It's driven by sentiment as much as by fundamentals. One thing is certain, Trump's policies are adding fuel to the fire. Trump's love affair with tariffs is no secret. He sees them as a way to protect American jobs and reduce the trade deficit. But his tariff wars have also created uncertainty and disrupted global supply chains. This uncertainty has been a boon for gold. As tariffs bite, businesses and consumers face higher prices. This fuels inflation, which erodes the purchasing power of currencies. Gold, on the other hand, is seen as a store of value. It's a tangible asset that's not subject to the whims of central banks or governments. So, as inflation rises, so does the demand for gold. Monetizing Fort Knox, a golden goose or a fool's errand. Trump's most radical idea is to monetize America's gold reserves. This means revaluing the gold held at Fort Knox to its current market price and even selling a part. This would create a paper profit that could be used to reduce the national debt or fund infrastructure projects and tax cuts. On the surface, it sounds like a brilliant plan, but economists are divided. Some argue that it would trigger inflation and undermine confidence in the US dollar. Others believe it could provide a much-needed boost to the economy. They argue that the inflationary impact would be minimal and that the benefits outweigh the risks. Trump 2.0 is no longer pressuring Fed Powell to cut rates, but may be planning to issue fewer US bonds by selling gold to support deficit spending. Trump is still indicating lower borrowing costs by targeting a direct supply of fresh US bonds debts. For this, Trump may use a part of the US gold reserve. Sovereign wealth funds, a gold-backed future like the Bretton Woods system post-WW2 in 1944, which the US abandoned in 1971. Another option on the table is the creation of a sovereign wealth fund. This would see a portion of America's gold reserves used to seed a fund that would invest in a range of assets. The goal would be to generate long-term wealth for the nation. Proponents argue that it would provide a cushion against future economic shocks and reduce America's reliance on debt. Critics, however, warn that it could be mismanaged or used for political purposes. They also point out that it would reduce the liquidity of America's gold reserves. Bond yields under pressure. Trump's balancing act. Trump's economic policies have put upward pressure on bond yields. His tax cuts and deregulation have boosted economic growth prospects, but they've also led to larger budget deficits. This may lead to increased borrowing by the government, which may push down bond prices and push up yields. But Trump wants lower bond yields to make it cheaper for the government to borrow money. Thus, Trump may monetize or sell part of the US gold reserve to fund deficit spending, rather than issuing fresh bonds. This could lead to a meaningful correction for the yellow precious metal. The gold standard. Weighing the potential impact. If Trump decides to monetize America's gold reserves, the impact on the gold market would be significant. It would likely send the price of gold significantly lower. This is because it would effectively increase the supply of gold in the market more than demand. It could also lead to other countries following suit. This could trigger a global scramble for gold sales, pushing prices down even further. The impact on bond yields will be negative. It could lead to lower yields. Key factors contributing to the rise in gold prices. Safe haven demand amid lingering Gaza war uncertainty. Gold surged after Gaza war broke out in October in 23, Fed easing cycle. Gold was also boosted by the Fed easing cycle and QT tapering from early 2024. Trump's tariff threats have amplified the appeal of gold as a safe store of value during uncertain times. Investors tend to move towards safer assets like gold when trade tensions and economic uncertainties increase. Global economic uncertainty. The announcement of tariffs has led to concerns about a potential escalation of trade wars, which could negatively impact global economic growth. Inflation worries. Trump tariffs may exacerbate inflation within the US by around plus 0.7% if implanted at face value. Concerns about higher inflation and slower economic growth are spurring demand for safe haven assets. Growing devaluation of local paper currency. Gold is a major beneficiary of increasing public deficit, debt, and currency devaluation. Trump's tariff policies hurt almost all major global currencies against USD, which is benefiting as a trade war currency. But even with higher USD-US bond yields, gold is getting a boost against USD as Trump's expansive fiscal policies may be negative for USD as more USD may come into circulation as a result of Trump's tax cuts and various fiscal stimulus even after considering higher Trump tariffs. Central bank buying, BRICS. Central banks, particularly China's PBOC, India's RBI, and the Central Bank of Poland and Turkey have been increasing their gold reserves, signaling a commitment to diversifying their FX holdings and also to combat local currency devaluation against USD, amid Trump trade war tantrum and uncertain bellicose policies. Central banks added 1,045 tons to global gold reserves. Central banks have been net buyers of gold for the past 15 years. The National Bank of Poland was the top buyer with 90 tons, followed by the Reserve Bank of India, RBI, with 72.6 tons, and the Central Bank of Turkey. Precious metals. Gold has been seen as an inflation hedge, a haven physical asset for centuries. In the last few weeks, gold waved on Trump's trade war tantrum. Trump tariffs, including reciprocal tariffs, are positive for USD and negative for gold. But gold and silver also surged in the last few days since Monday, the 10th of February 25, after Trump talked about metal tariffs imposition. The market may be now apprehending gold itself might be taxed by Trump. The U.S. has a healthy demand for physical gold across investment, jewelry, and industrial sectors, met by a combination of domestic mining, imports, and recycling. Currently, there are no tariffs on gold imports into the U.S. If tariffs were imposed, they would likely increase costs, potentially reduce demand, and shift supply patterns. But tax or no tax, the physical demand has increased suddenly for the last month after Trump's inauguration on the 20th of January 25. LME BOE is now scrambling to supply physical gold, while gold premium is now around $3,020 against the spot price of around $2,905 and future price of $2,935. The market is now expecting spot gold to reach around $3,000 by the next few weeks. A golden opportunity or a glimmering mirage? Trump's gold gamble is a high-stakes game. If it pays off, it could secure his legacy as an economic visionary, but if it backfires, it could trigger an economic crisis. Only time will tell what the outcome will be. But one thing is for sure, the world is watching keenly, and Trump's uncertainty is not good for any asset class including stocks, and even gold.